All right, let's dive right into this explainer and explore how two entirely distinct tech revolutions are basically tearing down the 600-year-old closed vault of traditional banking. For centuries, the way we interact with our money has been defined by one undeniable reality: the bank holds the keys. Period. But today, we're going to look at the source material that reveals how application programming interfaces, or APIs, and blockchain technology are forcing those massive vault doors wide open and completely rewriting the rules of finance in the process.
So think about your bank account for a second and ask yourself, who really holds the power here? Because historically speaking, you've kind of just been renting access to your own wealth. Sure, you could open up your laptop and look at your balance on a digital screen, but what if you wanted to quickly move it, share it, or let a third-party app analyze your spending habits to save you money? Well, the bank would usually just say no, citing security. But the harsh truth is, the bank owned your data, and they got to dictate exactly what you could and couldn't do with it.
It's actually wild to think about how little this dynamic has changed over the centuries. Honestly, whether you had physical gold sitting in a vault at the Medici Bank way back in 1472 and you just held a paper receipt, or your salary is sitting in a Chase Bank database in 2015 and you're holding a smartphone app, the foundational model is exactly the same. The bank owns the ledger. It really wasn't until the 2008 financial crash completely shattered our inherent trust in these institutions, followed by the iPhone proving that software could actually be beautiful and user-centric, that the cracks in this vault finally started to show.
Okay, let's move into Section 1, inside the closed bank vault.
Before we can really understand the revolution, we have to look at how banks aggressively protected their three core monopolies: their monopoly on your data, their monopoly on the transaction rails, and their monopoly on trust. Because banks completely refused to build secure doors for outside apps to plug into, early fintech developers basically had to climb in through the windows. To get around this closed vault, early budgeting apps had to rely on a process called screen scraping. It was honestly a terrifying and incredibly brittle hack where you essentially handed over your master keys, literally your actual bank username and password. The app would then log in pretending to be you, copy and paste the raw HTML from the website, and inevitably, the whole thing would break every single time the bank updated its website design. This is literally how early versions of Mint and PayPal had to operate, and it carried massive security risks for the user.
Which brings us to Section 2, Open Banking and Getting Your Data Back.
Interestingly, this first major rebellion wasn't actually driven by Silicon Valley at first. It was driven by regulators globally, who looked at this closed system and mandated a massive new rule. Your data belongs to you, not the bank. The absolutely crucial point here is that open banking forced banks to build secure APIs, eliminating the need for you to ever share your password again. Think of an API as just a standard plug. I absolutely love this analogy from the source material. If the bank is a massive power plant, the API is the standard electrical outlet on your wall, and your budgeting app is the toaster. Before APIs, you dangerously had to hotwire the power plant just to make toast. Now, you just plug it in securely.
To really put this into perspective, just look at the night and day contrast here. Open banking turns a sluggish, 5-day paperwork nightmare into a totally seamless data share. In the old 2014 way, getting a loan meant downloading and uploading 6 months of PDF statements, waiting around for a human to read them, and just hoping for the best. Today, in the open banking era, you simply click Connect Bank. The API securely sends tokenized data in 2 seconds. An AI instantly verifies your income stability, and boom, the money is in your account in 10 minutes. You shared your data exactly once, the lender never even saw your password, and you have the power to revoke that access at any time.
But what if we didn't stop there? Section 3, Web3, the bankless bank. Because what if we didn't just add secure doors to the vault? What if we deleted the vault entirely? In the mathematical rebellion of Web3, blockchains themselves act as public APIs. Where open banking uses legal regulation to change the system, Web3 uses pure mathematics. Your crypto wallet, like MetaMask for example, becomes your universal login, putting the mathematical keys directly into your hands. A Web3 wallet acts as a bank account, a username, and an API key all rolled into one. Any application can request a payment or read your balances, and absolutely no bank permission is required. Hitting Connect Wallet is literally the new single-click login for finance.
Now, what's really fascinating here is how decentralized finance, or DeFi, acts like financial money Legos that you can instantly snap together without a CEO or a bank manager ever approving it. Because the code is public and open, you can stack these protocols seamlessly. You can use Ethereum as your base money, instantly swap it on Uniswap, lend it out to earn interest on Aave, or use Maker to mint a stablecoin. And you can chain all of these complex actions together in a single transaction, natively on the internet, completely bypassing the traditional financial system.
And just to give you an idea of the sheer scale of this mathematical rebellion, DeFi protocols surged from literally zero to an astonishing $180 billion in total value locked between 2019 and 2021. Let that sink in. $180 billion, managed entirely by code and users, proving the immense demand and raw power of a truly bankless system.
So where is this all heading? Section 4. The ultimate financial merger.
Right now, we are actually watching the legal keys of open banking and the mathematical keys of Web3 merge to build this frictionless, unified financial future. Historically, getting your regular fiat money from a traditional bank into a DeFi wallet was a huge pain. You had to pay high fees to clunky, centralized exchanges and wait days. But now, you can just click buy $100 of Ethereum directly inside a decentralized app. The app pings your bank via an open banking API, you quickly approve it on your phone, and the crypto is sitting in your wallet in 30 seconds. The traditional bank essentially just becomes a dumb pipe, and all that user friction completely disappears.
And this profoundly shifts the landscape of credit. In early DeFi, you literally had to put up $150 worth of crypto just to borrow $100. They had to be over-collateralized because the blockchain has no idea what your real-world credit score is. But in this merged future, by using open banking to securely read your traditional bank income and pairing it with a really cool piece of cryptography called a zero-knowledge proof, which basically proves to the blockchain that you have good credit without leaking your actual underlying data, billions of people can suddenly access DeFi loans without needing massive piles of collateral up front. So the ultimate endgame of this merger is the super app of 2030. Imagine just opening one single dashboard on your phone that shows your traditional bank balance, your crypto, and your stocks all in one place. An embedded AI automatically routes your money between traditional banking rails and Web3 crypto rails to find the absolute cheapest and fastest path for whatever you're trying to do. If you're sending money domestically, the AI might use a traditional bank route. If you're sending it internationally, it might instantly swap it to a stablecoin and fire it over a blockchain for fractions of a penny. And the best part? You don't even have to think about it. It just works.
But wait, Section 5, Risks and New Gatekeepers.
Before we go throwing a party for total financial freedom, we need to impartially unpack the frankly terrifying new risks of holding your own keys. Because in this radically open landscape, you are taking on responsibilities that used to belong to massive, insured institutions. An estimated $100 billion has been permanently lost simply because users forgot or mishandled their Web3 seed phrases. Remember, when you hold your own mathematical keys, there is no forgot password button. There is no customer service hotline or 911 to call in a bankless world. If you lose your seed phrase or accidentally click on a malicious phishing link, your money is gone forever. The risk shifts entirely from the bank directly onto your shoulders.
And then there's the privacy piece, which gets incredibly complex. While open banking carries the risk of AI bias, where an algorithm might unfairly deny you a loan based on your spending habits, and turns data aggregators into massive targets for hackers, Web3 exposes you to irreversible phishing scams. Plus, you have to remember that on a public blockchain ledger, your transaction history is visible to everyone, permanently. If you aren't really careful with multiple wallets or advanced privacy tools, your salary, your charitable donations, and your daily spending are fully exposed for the whole world to see.
So we have to be vigilant here, because if we aren't careful, the old bank monopolies will simply be replaced by new tech gatekeepers. Sure, the data and the blockchains might be open, but the actual companies building the APIs, oracles, RPCs, and wallet software, companies like Plaid or Infura, could easily become the new toll booths. Think about it. If an infrastructure provider goes down or an app store suddenly bans your crypto wallet, you could find yourself locked out of the financial system all over again.
But let's be real. Despite those very real risks, the paradigm is fundamentally shifted forever. Open banking used regulation to give you your financial data back. Web3 used mathematics to give you your actual money back. Together, they are completely dismantling those legacy monopolies of data, rails, and trust. For the very first time in 600 years, you actually have a genuine choice in exactly how your wealth is stored, moved, and leveraged. So I'm going to leave you with this final thought. You have the power now. The vault is wide open. But how will you protect your financial future in this radically open landscape? Are you going to take the time to truly understand these powerful new tools, or will you end up just handing your keys right back over to the next giant tech gatekeeper?
The choice is entirely yours. Thanks so much for joining me on this explainer, and I'll catch you next time.